I discussed in my last video the funds available for distribution as an important financial metric for evaluating dividend coverage for equity REITs and also for valuation purposes. Funds available for distribution is also a relevant metric for U.S. energy infrastructure companies. In my next blog, which will be published on Saturday, I will discuss selling my highest cost 10 shares of Williams Companies. The symbol is WMB at $36.12. The profit was somewhere around 180 bucks or so. Williams owns pipelines and other energy infrastructure assets. The pair reduced my position to 104 plus shares with an average cost per share of $23.96 and increased my dividend yield at the current quarterly penny rate to 7.47%. This is one of the risk reduction trading techniques that I utilize. For an energy infrastructure company that uses GAAP accounting, there will be a very large non-cash depreciation and non-cash amortization expense. GAAP net income will consequently be well below free cash flow. In the third quarter of 2023, WMB reported net income of $654 million or 54 cents per share, but that included a $130 million gain from an asset sale. The gain from an asset sale would not be included in a funds for distribution kind of calculation. The funds available for distribution was reported at $1.23 billion or $2.26 per share. Non-cash depreciation and amortization expenses were $521 million for the 3 months ending in September 2023 and at $1.466 billion for the first 9 months of 2023. So those are significant non-cash expenses that reduce GAAP reported net income. As with many other companies where I own the common stock, my position in the senior unsecured debt is larger than my position in the common stock. I currently own $10,000 in principal amount of WMB senior unsecured debt. As with most other corporate bonds that I own, the maturity will be mostly within 2 years, although I think I own 2 that mature in 2027. I will not buy energy infrastructure stocks that are organized as limited partnerships. In my opinion, the tax accounting when preparing my tax return, which I do myself, is simply not worth the trouble or the effort. One point to keep in mind is that at some future point in time, a pipeline may have no further use since it connects to a field that is no longer producing and consequently has no value. Actually, it may require some demolition cost to get rid of it. Another issue is that building new pipelines has become so contentious in the United States that incumbent pipelines have natural monopolies similar to railroads in many respects. No one, for example, is going to be able to build a railroad yard in downtown Nashville to replace the one that is currently occupied by CSX, which is a stock that can be bought. The CSX train that goes by my house frequently, or close to my house within a mile, is going south, and it is a natural monopoly. Nobody is going to be able to replace that line with a competing railroad. Similar points can be made about many of the existing incumbent pipelines. There's no way that a competitor can build another line that services the same 2 points geographically.